Now, here we're going to talk about a lot about China, and we're not going to talk as much about other pieces of Asia just because there's a lot of things to cover based on some of the information that's come out recently. So we wanted to lead off with the Caixin Chinese manufacturing PMI, which you can see was expected at 50, came in at 49.5, and new orders came in at 49.3. So yeah, we're moving back into contraction, which again is what we had expected on the manufacturing front, because one of the things that we talked about during the lockdown is manufacturing maintained some pretty steady production. Obviously, we all know about the different videos that there were obviously some shutdowns, but for the most part, things stayed fairly consistent. But there's where, when we look at things in general, Caixin Chinese manufacturing PMI, the new orders only had a small reprieve, but continued its negative trajectory, which if you've been watching the rest of these segments, we talked about the drop in TEUs. We've been talking about the drop in total trade volumes. You know, the essentially the big box movers within the U.S. that account for 80% of volume saw a decline of between 8% and 13% in Q1. So here's where you see a lot of down move in general when we look at some of these pressure points, which is why I think they're misconstruing where some of these things are in terms of the credit impulse. And the view is it's sending a buy signal. You know, that's where I think that is incorrect. I don't think it's sending a buy signal. I think it is sending things are flattening, and we're seeing some of this baselining in terms of what is happening, because we actually just had this just yesterday, we had the PBOC remove a sizable amount of liquidity out of the market. It was almost 30 billion yuan, which again is just showing that there's an unwillingness to let that go. But there's also other pieces to it. So when you look at exports rose 8.8% year on year in dollar terms, but was compared to 14.8% in March. Imports dropped 7.9% last month versus 1.4% in March. And remember, imports are a leading indicator for exports and local demand. That is clearly dropping off, which is a big problem in the underlying scope of growth, because they need this significantly. So again, those forecasts continue to show April's plunge also came from a low base, with shipments this time last year disrupted by COVID. So your comp was easier and you still missed. And that is, I think, the crux of the slowdown that we're seeing. And again, we talked about it in the EIA show. We talked about it previously in segments 1 and 3. The U.S. just isn't the buyer it was because of a lot of these pressure points. Growth rates from the low base due to COVID disruptions. Exports fell 6.4% in April this year. In the official manufacturing PMI also slowing, as we've been saying, with the new export orders index falling from 50.4 to 47.6. So again, it even shows you that going forward, we're going to see more problems in general, which is why, again, this is not a time to step in. The other big problem is Beijing wants state-owned enterprises to play a bigger role in the country's tech innovation push. But that's going to crowd out private investors, because it's like, well, who's going to get the favorable treatment? The company, the state-owned enterprise? Or me, the little peon that's trying to innovate out of my garage. That is going to be a very big problem, because this is a suboptimal innovation policy, to say the least. Showering resources on the state sector will crowd out, again, the private sector. Then you've had recent national security raids on private consulting firms, Bain, Capvision, Mintz, which, again, why? So fears are high that the raids form part of a broad campaign targeting foreign businesses. So you're seeing exports slow. Why am I investing in China? So you're raiding these companies, and I'm going to be different. So I'm going to come in and be protected. I'm going to bring my innovation. I'm going to bring my technology, and you're going to give state-owned enterprises a leg up versus me. So in March, authorities raided the Beijing offices of U.S. corporations. This month, officials confirmed they have raided multiple offices of the New York, Shanghai headquartered research firm. An additional information vacuum. Chinese officials have not publicly commented on it. Domestic media has been quiet on it, while the probe continues to be ongoing. So again, there's so many unknowns, but let's get the campaign isn't targeting foreign businesses alone, namely insiders at Chinese companies or quasi-government bodies selling sensitive information related to national security or commercial trade secrets. So the question is, are they cracking down on the locals? Is it the sale of information from local entities to these foreign nationals? It noted the company had persuaded Chinese experts to advise foreign clients in sensitive areas, including national defense, military. So again, there's these back and forth. So what is relevant is that there is a flow of sensitive information to foreign entities via third parties. That's, again, what they're saying. But previously, this trade took place in an unregulated gray zone. But against the backdrop of growing tensions and of competition with the U.S. and the U.S.'s allies, stamping the trade out had become a national security concern. The major concern is that the critical information obtained through this process could be used to sanction or outcompete Chinese companies. So again, it's going to be back and forth. But this, to me, even though they're trying to say, no, we're not targeting foreign companies, well, it's like, well, some of this was done in a gray zone. So when do I know if a gray zone becomes a no-no? This is a communist organization. At what point can they change policies? And don't get me wrong, policies can change anywhere, but you can usually see it because it has to go before Congress or it has to go before the parliament, and then there's debate on it and you can prepare for it. This is a communist nation that can change at a whim. Like, it's going to be. So again, these are why some of these key issues remain a problem. Coming back into this, so we covered, again, manufacturing, we covered some of the foreign domestic exports, but Golden Week was stronger. One of the things that we've been saying is that things were going to get better for the consumer, and here we are seeing some of those increases when you look at Golden Week, nearly matching 2019 levels. Our view is that there's the bounce now because everybody had a lot of activity. They were cooped up. You had a strong Q1. You had a strong Golden Week, Labor Day. Now things slow. And one of the reasons why we're going to keep looking at the gasoline data in China or I should say the traffic data, is because we think that things are going to slow from this point. Now, looking at some of the key pieces, we talked about the exports and whatnot, but CPI slowed again. It was expected to be at 0.3, came in at 0.1. PPI was expected at negative 3.3, came at negative 3.6. So you're supposed to be seeing increases if demand internally is generating more, and you're seeing deflation, which again leads to, well, how active are people? Like, are people really that active? Which again creates some of those problems. Back to the aggregate financing. The estimate was for $2 trillion. It came in at $1.2 trillion. Again, that is negative for credit impulses. Money supply for M2 shrunk from 12.7 prior to 12.4 below estimates. New yuan loans were expected to be at 1.4 trillion. They came in at 718 billion. So again, that contraction. So it's really hard to say, well, what is happening in general? What's the likelihood that this is going to continue? And that's where we see, again, more and more pressure. And that's why the credit impulses, as we've been saying, they're going to try to flatline them because they still need to pull liquidity out of the market. Now it's time to talk about Taiwan, China. One of the things that we've been saying is that China is not going to invade Taiwan, at least in the next 5 years. Just putting in an arbitrary number on it. It's the manpower it would take to do that is Herculean on that level. So I think we have to put that to rest in terms of where that's going to be over the next, let's call it 2 to 3 years. The other issue is, you might say it's like, well, they can come in, they could carpet bomb, they could do a lot of different things. It's like, technically, yes, but what they want in Taiwan would be destroyed by missiles, would be destroyed by trying to soften some of these key areas. And the Taiwan itself does not quite lend itself to an easy landing. I mean, you're talking about something that would likely be twice the size of D-Day to try to make a beachhead, which again would also create more stress and whatnot. So Taiwan will, China will continue to saber rattle. We don't see that changing, but the rhetoric is starting to shift softer, closer to what we think is likely the underlying kind of component of it all. Beijing wants to dial down tensions. Tuesday, Wednesday, Wang, chairman of the Political Advisory Board, presided over the party's annual Taiwan Work Conference. Compared with last year's conference, which promised to resolutely smash Taiwanese separatism, Wang's comments were very dovish. We must uphold, here's some quotes from it. We must uphold the concept of one family on both sides of the Taiwan Strait, respect, care for, and benefit our compatriots in Taiwan, and improve the systems and policies that enhance the well-being of our compatriots. We should gradually resume and expand cross-strait exchanges, make friends with people from all walks of life in Taiwan, and promote spiritual harmony among compatriots on both sides of the Taiwanese Strait. So now when you look at that, it's like, well, despite what you may read in the different press, China has no intention of trying to take Taiwan by force anytime soon. Taiwan is much more of a risk to be managed than an opportunity to seize. The mainland's new softer tone may be aimed at giving Taiwan's Beijing-friendly party a fighting chance in the island's presidential election. So there's a presidential election coming up, but the limitation on chips and movement of advanced technology going into China is hurting them significantly. So if they can soften their stance on Taiwan, that might allow them to also make friends with others, which would allow them to then continue or lift some of the sanctions on some of these recent semiconductors and other pieces. So again, this is kind of where we sit at the moment. But there's also the issue on the economy. The economy is not in a good spot. So much for the China opening the credit taps. After a jump in March, credit growth was much weaker than expected in April, and the credit impulse has been neutral for several months now. And this is for anybody that has been watching us. We have said that the PBOC's dream is keeping this at zero, between -1 and 0. And here we are. This chart has been updated for the most recent data. The previous one had not. And you can see where things are settling out and how this is, again, why we just don't think stimulus is coming into this market. Monthly exports to Russia by country. Obviously, China is massive, which is going to be, again, they have to pick their battles. Why deal with Taiwan to this level where you're going to have to deal from some fallout with how they're dealing with Russia? Chinese exports blue and imports red to and from Russia in April of every year from 2007 to 2023 gives you an idea of just how much is continuing to be imported, and that a lot of that is obviously on the level of energy. When you look at some of the different flows, Xi emphasized the importance of Ukraine's territorial integrity and announced that China's special representative for Euro-Asia affairs would travel to Ukraine to mediate an end to this. China is ready to work with Russia to strengthen strategic communication and consolidate and deepen cooperation in various fields. China will stay committed to promoting peace talks and stands ready to keep communication. Russia agrees with China's principal position on the Ukraine crisis and stands ready to keep close communication with China in a candid manner. But just because Beijing is pushing for a political settlement in Ukraine doesn't mean it's getting cold feet on Moscow. China views Russia as far too important a strategic partner to throw the country under the bus. So, excuse me, when you look at some of the things that are happening, we're going to let China do whatever it wants with Russia because we need prices to remain cheaper in China, and they can maintain whatever relationship. But when you look at China renminbi, when you look at Russia and China and renminbi yuan, you look at Russia, India, and rupee, Russia's pushed back on accumulating too much of either. And I think that's interesting when you hear people talk about the death of the dollar, where it's like, but Russia's pushing back on accumulating too much of these entities. And I think that's a little interesting point when you start looking at the framework of trade going forward, which is why I think it's going to be an interesting piece looking at how things will shake out. Now, we want to touch on the new order side again with the manufacturing PMI and how that credit impulse side has really started to slow. So when you put these two together, you get an idea of not only did the activity slow, but you're also getting new orders drop. So again, this chart showing that it's a buy signal. No, I think it's actually rolling over, which is going to be a bigger problem, especially if you look at COVID-19. Not surprising because it happened everywhere. The pandemic worsened inequality in China. In the private sector, the average wage in the highest paying industry was 2.91, that of the average wage in the lowest paying sector, and it was 2.26 in 2019. Regional wealth gaps also widened, and this is going to be a very big importance in terms of, because if you think Xi and common prosperity, which the whole goal was to reduce inequality, well, this has been in play since 2019, and since it's been in play, inequality's gotten worse, not better. Which again, when you look at the issues on foreign nation companies and all these things, there's more and more of a concern on what that is going to look like. So now when we start looking at Chinese consumer spending, a mean reversion in the process, when you look at it in general, retail sales of consumer goods in nominal terms are flatlining. They curled up a bit, but again, when we look at where they are now, we see this continuing to flatline and not continuing to improve. Households plan to save a bit less as employment security improves. But again, that breakdown in common prosperity, those issues in that region continue to be an underlying problem. And then Xi wants China to have modern industrial systems. And again, the Central Financing and Economic Affairs Commission met on last Friday to discuss it. The CFEAC must continue to play a major role in economic policy formulation and strengthen the party's centralized and unified leadership. So, but when you look at the deviations, it's, how are people going to spend? And this is going to be the biggest problem because the Central Finance and Economic Affairs Commission is, again, talking more about industrial systems, infrastructure. But when you look at the consumer, you're getting some of this flatlining. And again, like as we said, it was going to get better. It was always going to get better once lockdowns ended. But is it going to go back to the trend? And for us, the answer is no. And that's going to put some overhang in terms of the recovery that is expected coming from China, especially without that stimulus and that support. China's return to asset ratio, city commercial banks, overall commercial banks, city banks are worse than other banks. Domestic tourism has clearly recovered. But when you start looking at, okay, so tourism has gotten better, banks a bit worse. The credit impulses worse. Some of the spending kind of flatlining, pressure on foreign entities coming in, big drop downs in exports, big drop down in imports. Again, none of this is showing a lot of strength. And it's not just China. You look at Japan. Japan had a very weak account balance. Imports are slowing everywhere. Exports are slowing everywhere. We're seeing it come through what we've been talking about week in and week out on the EIA show. It's not getting any better here. Taiwan, core CPI, again, moving back up. There's pressure everywhere. And even as Taiwanese exports slow, you're still getting the stickiness in inflation. And it's not just the US, it's not just Europe, it's everywhere, which is why I think 2 weeks ago we showed that chart of, 97% of countries are still seeing increases in inflation. That is a huge problem when we look at some of these overarching themes in terms of rates and that pressure remaining. So that's what we have for you across the board. I know this was a bit longer. Hopefully this is helpful. If you have any questions, please let us know. If you'd like us to cover anything, happy to do so. And we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.